Did you know that BCE paid over 3.7 billion in dividend in the last 12 months? That's a lot of money for a company that is struggling with cash flow. What happens with Bell this year? Well, they had rough quarters after rough quarters. They got recently a credit downgrade, and I'm starting to get concerned about their dividend for 2025. So in this video, we're going to take a look at their debt situation, including the interest charges. We're also going to look at their cash flow situation, and we're going to end about what's going on with the dividend. I'm also going to throw some numbers from Telus, and at the end of this video, I'm going to tell you what I would do if I would be BCE's CEO. So far this year, BCE is not generating the returns that we hoped for. You're going to tell me, Mike, it's not the end of the world. Recently, the stock has been going back up. It's only minus 4%, including the dividend since the beginning of the year. Yes, that's not that bad, but when you see that the TSX 60 is up by 12%, well, you're very behind. So what's going on? Well, quarter after quarter, it's not looking good. Yes, they had a recent earnings jump, but the EPS is an accounting number. So we have to dig in a little bit deeper and look at other metrics such as revenue that is struggling, cash flow from operation that is struggling, and debt that is increasing. So that all led to this final nail in the coffin maybe, but Moody's just downgraded their credit rating one notch above junk grade, which is not that good, right? So of course Moody's said, well, we look at the debt, we look at the debt to earnings ratio, the capacity of that company to continue moving forward. I would just want to make my own opinion, and full disclaimer, I have no shares in BCE, so I'm really doing that deep dive to understand a little bit better what's going on with this company and if the dividend is safe for 2025. So when I have a question like this, the first thing I do is I look back into financial statements. It's kind of boring, but this is the hard work you have to do to answer those questions. Instead of coming with the regular, it's going to be fine, they've been around for a long time, they're telcos, they're not going to die. Well, tell that to AT&T shareholders, right? So going back into 2023, I was looking at their debt situation. So it was up 12% versus 2022, meaning that they got even into more debt last year, and the average weighted interest rate was 4.41. Well, now you can think that as debt comes to maturity, it's going to continue to increase. So where's the debt today? Well, it's even higher at 39 billions. And the interest charges keeps going up. Over the last quarter, so Q2 2024 versus Q2 2023, that interest charges was up 19%. So we have a business that keeps on going into debt, that the interest charges will continue to increase, and even if Bank of Canada reduced their rates as like a few times lately, it's not going to change much because now they have a weaker credit rating, so chances are they're going to pay more than what they already have in their balance sheet. So what's coming up in the next 12 months? Well, 17% of their debt is up for renewal. We're talking about over 6.5 billion that needs to be renegotiated at, of course, a higher rate. If you go back in time and look at the same situation in Q2 2023, you saw that between Q2 2023 and Q2 2024, the debt that was going to be renewed was for 6 billion. So long story short, we are in a similar situation that we were last year, and the interest charges was up 17% over the past 12 months. So you can expect that we're going to see another interest charges going even higher up. And I calculated what was the last 12 months in interest charges paid. That was 1.6 billion. Assuming that Bell keeps on getting into more debt and renewing their debt at a higher interest rate, so increasing their interest charges by another 20%, well, guess what you're going to have in 12 months from now? $300 million more into debt payments. That's not great, right? That's definitely not great. So that will hurt again the cash flow. So now the situation is, yeah, but Mike, BCE got into that debt to invest massively in 5G technology so it can generate more cash flow. let's dive into the cash flow situation now. Unfortunately, when you look at cash flow from operation and free cash flow for BCE, it has not moved since 2020. So you can blame the pandemic all you want, but it's been 4 years that we are not in growth mode. Actually, it is the situation for all the big guys. So if you look at this graph, you will see that Telus and Rogers got a jump in revenue as of late, mostly driven by acquisitions. Overall, if you look at quarter to quarter, all of those big three that are very strong in the telco's business, well, they don't generate much revenue growth. Well, with weak revenue growth, what comes in? Weak cash flow from operation growth as well. So they will need to find either growth vectors or magically get more clients, because the interest will continue to go up and things will be fine, will not just cut it. Actually, when you look at BCE guidance for 2024, you see again the same narrative where, well, revenue is not expected to grow that much and we expect declining free cash flow. So what's going to happen in the next 12 months? Well, chances are, if you have less free cash flow, Bell will have to get into more debt, increasing their debt level, increasing their interest charges, and putting their dividend even more at risk for 2025. So I've always seen Bell as a deluxe bond. So deluxe bond, by my definition, is a stock that I don't expect much capital appreciation. So meaning that the stock price will remain about the same, but with a great yield and offering a decent dividend growth that should match or beat inflation. It's been over a decade that Bell offer a 5% dividend growth year after year, until this year. Well, in 24, they reduced the dividend growth to 3% only. So what's going on? Well, if you look at the cash flow situation, since 2021, BCE had borrowed money to finance the dividend. And of course, there is an explanation for that. BCE is a capital intensive business. They had to invest massively in maintenance of their network and developing the 5G technology. That's totally fine. So for a short period of time, it totally makes sense to borrow more money than you can afford, because you have to invest in your business while you're paying a juicy dividend. I totally get that part, but keep in mind that this is not sustainable. At one point, BCE needs to turn things around, generate higher cash flow, which they do not expect for the rest of 2024, and pay down the debt and also keep the dividend alive. Well, right now, it's not looking that great. But before I tell you what I would do with a dividend, let's take a look at Telus. And full disclaimer, once again, while I do not have shares of BCE, I do have shares of Telus and is part of my top 10 largest holdings. So Telus situation is not that different from a debt perspective. So for the past 12 months, the debt has increased by 6% and their interest charges has increased by 23%. So while they got into more debt, it's a little bit less than what BCE did, but in terms of interest charges, they're definitely in the same boat. However, Telus kept their credit rating so far, and for the next 12 months, they only have $1 billion in debt to renegotiate. So their interest charges will likely be a lot less than what Bell will see on their balance sheet in the next 12 months. I've done a few videos about Bell versus Telus over the past 12 months, and I've told you each time that it's really important to follow the cash flow metrics. So when I compare BCE to Telus over the past 4 or 5 years, I see that Telus has actually increased its cash from operation while BCE is still struggling doing this. So the narrative where the telco borrow a lot of money to invest in the future, generate more cash flow, and eventually pay down that debt, well, Telus seems to be on the right path, while BCE hasn't figured it out yet. Finally, for the guidance of 2024, while it was a big disappointment to see that Telus expected at the beginning of the year to generate 2.3 billion in free cash flow and now we're down to 2.1, it's still a lot more than what they paid in dividend over the past 12 months. So over the past 12 months, they paid close to 1.5 billion in dividend, while they will generate 2.1 billion in free cash flow. In other words, they will not have to get into more debt to finance their projects on top of paying a juicy dividend. dividend. And this is why I am willing to hold onto my shares of Telus, because I can see that they're on the path to recovery where better cash flow, better free cash flow, and a little bit more room to pay the dividend. Now let's wrap this up with a conclusion where I will tell you what I would do if I would be BCE CEO. If you are shareholders and you count on that dividend, you will be glad that I will not be the CEO anytime soon. But personally, I would cut this big debt. From a business perspective, the dividend is only cash flow getting out of your bank account. So right now they have an obligation to pay nearly $4 billion of their free cash flow to shareholders. When you go back to the definition of a dividend payment, this money should be distributed to shareholders when the company has no other projects and cannot create more value. Therefore, it gives the extra cash flow to shareholders so they can allocate it elsewhere and generate better returns. In this situation, Bell has created this hard place where they're stuck paying a generous dividend. They will not want to cut it, and I don't think it's going to happen actually, because I'm not the CEO, and I'm pretty sure the CEO will decide to keep it as is, which would be the best case scenario for you guys. But when you really think about the business perspective, not the investment perspective, you have a business that is struggling to generate growth, that get into more debt year after year. And now all you have on the table is wishful thinking that you're going to generate more cash flow in the future, while you don't even expect that this will happen for the next 6 months. Well, the real solution will be to be an adult, cut the dividend, reduce the debt, and find growth vectors. As long as they are not doing that, BCE's share price will continue to struggle, and I think the dividend is still at risk going forward, because at one point or another, management will not have any other choice but to look at the hard facts and look at the numbers and then make tough decisions. Once again, I don't expect Bell to cut their dividend in 25. But seriously, if they increase it again, that will be quite irresponsible. Because when you look at the numbers, there's no room for more growth here. It's not creating value, it's actually destroying the balance sheet. And I don't like when a company is destroying value. So I'll see you in the comment. Don't forget to give me a thumbs up, like the channel, subscribe to do not miss a next video for next week. And until then, don't forget to stay invested. You really didn't think that I would not talk about Bell selling its stake in MLSE, right? Well, I feel like in a Marvel movie right now. So we have a conclusion and then another conclusion's coming up. So I uploaded the video, everything was edited, and then boom, yesterday, BCE announced that they will sell their 37.5% stake in MLSE, which owns the Toronto Maple Leafs, the Toronto Raptors, so a big chunk, super high quality asset, to Rogers for the small amount of 4.7 billion, which is pretty cool, right? So 4.7 billion, the transaction is expected to close around mid-2025. Does it change anything in this video or in my view of BCE? Well, first I would say it's one good step to pay off some debt, clean up the balance sheet, but we're not out of the woods yet. It doesn't change the fact that BCE is still spending too much money in capex, interest charges, and in dividend versus how much they generate from cash flow. Selling an asset is not going to generate more cash flow over the long run. Actually, it's going to be the opposite. So yes, you are solving you have a short-term solution for a long-term problem. It's like if you have like a big amount on your credit card, you go on Marketplace, you sell a bunch of stuff, your children's toys or whatever, and then you pay off your debt. That's great, but if you still have a spending problem or you do not earn enough, you're going to run into that similar problem the next time, and you will not have this high quality asset to sell a second time. So overall, I am happy to see that Bell is taking steps toward a cleaner balance sheet, but what I really want to see is a long-term solution for this long-term problem, which means how in the world they will generate additional operation cash flow. So as long as they are not able to do that, I'm going to sit on the sideline for this one. So this time it's for real, no more ending. I'll see you in the comment. Give me that thumbs up, and we're going to talk again next week. And until then, don't forget to stay invested.